Joining us for a further look at what's playing itself out in that market scene is Cobus Potgieter from Southern Cross Capital. Cobus, always a pleasure. Hello.
Good afternoon, Alexander.
It is a Friday and markets are upbeat as they should be. Talk to us about the last 5 days and what we are seeing happen today.
It's been painful, and we were long due a bit of a relief rally. So it's nice that the earnings numbers over the US sort of became the catalyst for a bit of a bounce across sectors, and especially the beaten down sectors locally. And it even seemed to change the trend in China, which also managed to bounce towards the end of their close. And mostly driven by these numbers we saw. Big three names reporting. Apple, that was a negative result. Actually, they seem to be losing significant market share in China, which is an enormous market for them, around 20% of their total, and they seem to decrease around 13% in revenue terms in that market. However, Amazon and Meta posted enormous results, earnings growth. So the market seems to be taking the lead from that, and we're seeing a bit of a positive slant today.
I must ask you about Meta. They literally shot the lights out. When I looked at those numbers, I was quite surprised. And what I thought was interesting is Alphabet's coming out to say they're losing ad revenue, and Meta saying, well, this is where we're seeing a lot of our revenue gains.
Yes. So interesting sort of, there are all these sort of thematic concerns, and about a year ago, the metaverse and Mark Zuckerberg's obsession and this sort of funny personality became the theme, and people turned very negative on the stock, and they actually underestimated the management team's ability to change and adapt. And to be perfectly frank, the major adaptation that these guys have gone through is right sizing. They cut a massive proportion of their staff, reducing costs, and expanded margins. And just as the volume started coming back and they saw a bit of revenue growth, they were well positioned off a lower cost base, and this is the result. And a similar story from Amazon. There was some beats on revenue, yes, but ultimately a lot of the story comes down to cost control and margin expansion, and that's something we don't always expect from these tech stocks.
I was just ask you about Apple, seeing the demand therefore for their iPhone. I'm wondering if also a lack of innovation, if I'm honest, Cobus, has anything to do with it. As a person who enjoys the brand, it's been more of the same for quite a long time, I think just over a decade, with minor tweaks to each phone and the aggressive rollout of phones every single year. Might they have to rethink their strategy and their offering?
I know analysts that have been calling exactly what you are describing, and sort of anticipating that saturation of the market. Someday, the party's just going to stop. People are not going to keep buying the new phone because the improvements are so marginal since 2011. And that hasn't quite been the case. There might be some of that. Some of the environments they compete in are getting more competitive. This is actually the first quarter in a while where they've seen absolute revenue expansion, and volume expansion. So the story isn't all that bleak. I think the big miss is in China specifically, and there it looks like the local competition is actually heating up a lot. The likes of Huawei, who tend to compete against what Apple's lower ranging phone, which is just the previous generation phone that keeps getting sold with the latest one. So if we're at 15, we're selling the 14 as sort of the budget entry level phone, and that market is actually incredibly lucrative, and that's where they've been suffering from the local competitors, Xiaomi and Huawei. Really, coming to the fore, and of course, going the Android route and offering more features for the money. And of course, becoming quite sophisticated. And I wouldn't, even in sort of fashion conscious circles, you wouldn't be ashamed to pull those phones out. They're very sexy now. So perhaps it's a lack of innovation, but certainly the competition has caught up a lot, and this is a competitive issue. I wouldn't say it's a geopolitical issue or anything else, but it is an important base for them. It's where they do the bulk of their manufacturing, and they do expect that to be their largest market. So the market is taking that as a negative signal.
I want to bring it home now and look at Vodacom. They also enjoyed a great quarter there, boosted by Vodafone Egypt. Just talk to us about this set of numbers here with Vodacom. And that Egyptian market really, really boosting, giving them the kind of boost that they probably wouldn't be able to enjoy if they hadn't taken that risk a few years ago.
Yes, yes. Look, I always have things to say about these companies pursuing opportunities in Africa, but sometimes with outsized risk comes outsized reward, and that's a good example of that. I think they've done reasonably well in terms of cost control and trying to right size the business. It is a very mature business, and it's nice that they've been supported by one of the immature markets which they've entered into, and they've seen substantial expansion there. So a decent outcome, and continues to be a nice high yielder, which is sort of a nice blue chip to have in your portfolio, despite not being the most exciting prospect generally.
I'm also fascinated by their financial services division there. They managed to grow, I think, 31% in the quarter. That's quite a number. I'm very surprised, possibly, at how people are looking to these telcos to bring financial inclusion to them, or even just to move and use their money.
Absolutely. Look, we've been trying to emulate the M-Pesa model as it took off in Kenya specifically, and that's largely been disappointing. It hasn't quite happened, self-fund banking, all the rest, and there was a very specific situation which worked incredibly well for Vodafone at the time, and didn't quite that self-fund banking trend in the unbanked markets didn't quite become that massive golden goose that everybody expected it to be. Like some of this is also them selling insurance, and it is poorly priced insurance, but it is convenient insurance that we pick up at the points of sale. Um, there will be, and there continues to be some regulatory pressure there. Maybe not the highest quality of earnings, but certainly very lucrative and very attractive from an investor perspective that they do have that. So I'm not an expert. I'm not an expert on the expansion of self-fund banking in the unbanked market. But I think that is you know the other bone, the other leg of it isn't the highest quality, but well done to them for expanding into that market and making it work for now at least.
Another fascinating one I quickly want to touch on today is Sanlam. They've really been on an acquisition spree. I think Afrocentric, Bright Rock, the deal with Allianz, and now Ashupol. I guess consolidation is what mars this company at this point, and it looks like it works for now.
Yes, the market has mixed feelings about this one. They are paying a lot. I didn't realize Assupol was as massive as it was. That's like one of these big private companies that flew under the radar. And we've seen a bit of, after quieting down again, and again, we all like sing doom and gloom when the corporate action it gets quiet, but sure, it's picking up again now. We've had multi-choice this week. Now we've had Sanlam. So that's made for some exciting reading. This is what they call, as you've mentioned, some of these things have been ex-South Africa, but this is what they call as part of their Fortress South Africa strategy, where they're just trying to strengthen that book and look for synergies. We'll see what the competition authorities have to say. Again, because this is a private company, we don't really have a handle on their reach and what the regulatory hurdles to this merger would be, but they seem to be, maybe through emission, quite confident that this transaction will go through easily. So given the size of it, I find that surprising. So a 6.5 billion for a company most of us have never heard of, but be interesting to see what the outcome of this is. But as you said, bit of a mixed bag. Ultimately, I think they've come out on top relative to their peers through this consolidation and growth strategy. But we'll see if it continues to work for them.
Keen to get your stock pick, Cobus, in a jiffy. But first, I'd like us to reflect on counters that have found favor with your industry peers.
My pick for the first time in quite a few years, I will just add, is Tiger Brands. And I think this is the first time it starts to look interesting. They've appointed the new CEO, which is the guy who was previously at Premier Milling, which is a very good operation. And they've done at Premier, they did all the things Tigers were supposed to do and didn't do. So I think he's going to bring a new rigor into the business, a new operational focus. It's going to rationalize it. They've still got an incredibly great portfolio of brands, great cash flow, but they haven't managed this portfolio well for a number of years. The hard decisions haven't been made, and I think that's about to change. And then you add to that some of the bigger tailwinds. You've got input prices on food that's falling. You've got margin recapture, so they're all in a better space. I think the food producers over the next 6, 12, 9, 15 months, interest rates falling, soft commodity prices coming down. So I think there's a few reasons to like the story. It's not optically expensive either. I think it's trading at 11 times this year's earnings. So yeah, that's my top stock pick, Tiger Brands.
Greenrod. I know it was a pick I had a couple of weeks ago, but I still like the stock. If you think about it, they're playing into the weakness that Transnet is, and that the neighboring countries need to hedge themselves against. Everybody needs commodities to move. Everybody needs logistics to work. If it's not working here, it's going to work somewhere else. They happen to be the people in the spotlight. They're delivering incredibly well. They don't have a stretched balance sheet. And you can see the volumes growing. They have excess capacity that the volumes can grow into. They've done the right capex. I think this is going to be a winner for a period of time.
I'll go with Pepco. We know these are the owners, is a discount retailer. We've seen their Q1, a report showing that they managed to increase their sales by 7.2%, and that's despite the challenging macroeconomic conditions, including our port inefficiencies, and most importantly, the guys continue to gain some market share.
All right, Cobus, keen to get your thoughts on some of those Tiger brands, Grindrod and Pepco.
Okay, well, this is easier than last time, with the exception of Tiger Brands. So that's an interesting one. And I hate taking on individuals in these conversations, but the CEO change was incredibly positive for the stock. They need some more, like attracts like, and that management team has been soft for a very, very long time. Let's not name names, but a lot more needs to happen. I think while I agree with some of the theses in terms of the low-hanging fruit there, the market has largely given the stock the benefit of the doubt. It has rallied in excess of 20%, I think. And I'm not quite as positive that in the coming 12-month period we're going to see a massive improvement there. I think it's going to be tough for a while still, but at least we are moving in the right direction, and after and hopefully we can get some this trend of stronger, more capable execs coming through that can continue, people with a history of excellent operational execution. So I'm not quite on board with Tiger Brands, but at least I am on the other two. Grindrod, that thesis just keeps playing out. We are buying that one on the dips whenever they, as rare as they are. We saw the numbers coming out of the Richards Bay coal terminal the other day. That trend just persists, and having invested into Maputo, and that's just been such phenomenal execution. They're doing even more than that in terms of getting trains onto rails as well. So that's still a fantastic business, well executed, and we like it a lot. And finally, Pepco. I think similar to Mr. Price, maybe we will hopefully we'll turn a corner here, and given that base effect we saw from the load shedding, of course, their stores were not very well supported by backup power, so we should see a significant bounce off a very low base there, and hopefully beyond that we'll see some like-for-like volume expansion as well, and that one is also historically cheapest chips, so that's quite a nice one to have in this environment.
And which stock are you going with this afternoon?
Completely out of whack with everything else I've said today. African Rainbow Minerals. So we're seeing the resources were under serious pressure year to date, and this is one of the cheapest ones. And I think as we turn the corner on high rates, as China turns the corner, this is one of the a very cheap name that is very well diversified across a range of materials. And because of some technical factors, specifically the exclusion from some major international indices, in the last quarter of last year, it has become a bit beaten down because of forced selling from index trackers and quasi-index trackers. And because of that, it's looking very cheap for a very nice set of assets that is, again, being well managed. So we like African rainbow minerals for at this level.
Well, Cobus, always a pleasure speaking to you. Thank you so much for being with us this afternoon, and have a great weekend. That was Cobus Potgieter from Southern Cross Capital.